Every crash in the crypto market isn't merely an economic event, it's a psychological one. Bitcoin's chart is a mirror reflecting our deepest instincts: fear, greed, hope, and regret. What most call market collapse is often the reversion to emotional extremes. When Bitcoin reached its all-time highs, traders weren't just buying an asset. They were buying belief. Every green candle confirmed their conviction. Every dip was a buying opportunity. But what technical analysis quietly reveals is that belief without structure is volatility waiting to happen. Look closer at the chart patterns before the crash: ascending wedges, narrowing volume, RSI divergence. These weren't random coincidences. They were whispers of exhaustion. Momentum indicators were flashing warnings long before the headlines screamed Bitcoin crashes. The signs were there, but few were listening. The truth is, technical analysis is not about predicting the future. It's about understanding the present behavior of the market crowd. Each candlestick tells a story of buyers and sellers wrestling for control. When support breaks, it's not just a price level failing. It's confidence fracturing. The Bitcoin crash wasn't the market's betrayal. It was its honesty. Every parabolic rise demands a correction. Every emotional surge finds its equilibrium. The disciplined analyst doesn't fight the storm. They read its patterns. When the MACD turns down, when volume fades on rallies, when fear replaces euphoria, these are not just numbers, they are emotions quantified. To those who panic, the crash feels like an ending. To those who analyze, it feels like a reset. A crash wipes the chart clean of illusions and reveals where value truly lies. The most successful traders don't escape the crash. They study it. They ask, what was the market telling me before it screamed? Because every crash teaches one timeless truth. Price is not truth, structure is. So as we look at Bitcoin's volatility, remember, we're not battling numbers, we're navigating narratives. Charts don't lie. Emotions do. Learn to see through them, and every crash becomes not a disaster, but a data point in your growth as an analyst. Emotion creates structure. It's a principle that goes deeper than any trend line, moving average, or Fibonacci rich retracement. Every chart you see, every candle that forms is not a random occurrence. It is a portrait of human emotion rendered in price and time. When you look at a Bitcoin chart, what you're truly observing is the heartbeat of millions of participants, each one reacting to hope, fear, greed, or regret. Those emotions, when multiplied across time, build what we call structure. The market's rise and fall, its rhythm of expansions and contractions, are nothing more than emotional waves turned into data. At the heart of every bull run is optimism. Traders buy because they believe they will profit. Investors hold because they trust in the narrative. In those moments, green candles are not just indicators of price increase. They are affirmations of belief. Each surge upward feeds on itself, reinforcing the idea that this time is different. This cycle of emotional reinforcement is what creates parabolic structures. You see higher highs, faster accelerations, and sharper retracements. It's not technical mechanics driving it. It's human psychology accelerating without restraint. As confidence grows unchecked, support levels become ignored and risk management fades into the background. The chart grows steeper, volume spikes, and volatility expands. These are not merely signs of strength. They are signs of emotional dominance taking over rationality. Then comes the turning point. At first, it's subtle, a hesitation near resistance, a smaller green candle after weeks of relentless momentum. The energy starts to shift, though most don't notice it. Emotional structure begins to invert. Where buyers once saw opportunity, they now feel uncertainty. That uncertainty builds pressure beneath the surface, like a fault line waiting to break. As soon as one key support gives way, emotion flips almost instantly. Fear spreads faster than optimism ever did. The same traders who once refused to sell begin rushing for the exits. What was once greed-driven structure now becomes fear-driven collapse. In those moments, lose symmetry. Patterns break down, and what once felt like order becomes chaos. Yet even that chaos is part of the structure, because panic, too, has its rhythm. If you've studied enough market cycles, you begin to recognize that emotion doesn't just influence structure. It creates it. Every formation, from head and shoulders to double bottoms, exists because of the emotional cycle of hope and despair. A consolidation zone is not a pause in trading. It's a psychological negotiation between buyers who still believe and sellers who have begun to doubt. A breakout is not just a technical event. It's emotional momentum finding clarity. A breakdown is not simply weakness. It's collective fear reaching a tipping point. In this way, emotion becomes the architect of every pattern we analyze. In Bitcoin's crashes, this emotional architecture becomes especially clear. During its parabolic climbs, retail traders enter late, driven by excitement and FOMO, the fear of missing out. Institutions quietly distribute, using that retail emotion as liquidity. The chart records this transfer of enthusiasm as distribution zones, flat or narrowing patterns that often go ignored in the heat of euphoria. Then, as selling accelerates, the emotional structure flips. Fear dominates, volume spikes on down-count candles, and support zones vanish one after another. Yet, beneath that pain, a new emotional base begins forming. The disbelief and capitulation stages create accumulation zones, broad, stable structures that precede the next cycle. The market resets, not through randomness, but through the natural ebb and flow of emotional extremes. Technical analysis, when stripped of emotion, becomes mechanical. But when you understand that emotion is the invisible hand shaping every pattern, you start to see the market differently. You no longer view resistance as a line. It becomes a psychological ceiling, the point where optimism meets doubt. You no longer see consolidation as stagnation. It becomes emotional equilibrium, the quiet before the next surge of conviction. You realize that every candle, every wick, is a record of emotion crystallized in price. The challenge for any trader or analyst is not to eliminate emotion. It's to understand its rhythm. You can't remove fear or greed from the market because they are its energy source. What you can do is observe them without being absorbed by them. The most skilled analysts treat the chart like a language of emotion. They read what others are feeling long before those feelings turn into headlines. When a market grows euphoric, they recognize the fragility hidden beneath that enthusiasm. When the crowd panics, they see the early signs of stabilization. Their strength lies not in predicting emotion, but in interpreting it correctly. Emotion creates structure, but it also tests it. The market rewards those who can remain grounded while others are swayed by emotional tides. Every rise and fall, every crash and recovery is a lesson in collective psychology. Bitcoin's history has shown that prices may change, but human emotion doesn't. The forms it takes on a chart, waves, patterns, will repeat consolidationally because the emotions behind them are timeless. Understanding that truth is the foundation of every great technical analyst. Patterns don't predict. They reveal. This idea challenges one of the most common misconceptions about technical analysis. Many traders look at a chart hoping to find the one perfect pattern that tells them what will happen next, as if markets move by magic or formula. But charts aren't crystal balls. They are mirrors. They reflect what's already happening in the collective behavior of buyers and sellers. Patterns are not about foretelling the future. They are about understanding the present moment with precision and emotional clarity. When you look at a chart, you're not peering into the unknown. You're observing how participants are interacting right now. Each formation, whether it's a triangle, a flag, or a head and shoulders, is a visual representation of market psychology unfolding. It reveals where conviction lies, where hesitation forms, and where balance may soon shift. The purpose of a pattern isn't to guarantee a direction. It's to signal tension, pressure, and imbalance within the market's current state. In other words, it shows you where the market is coiling energy, not how it will release it. The release is up to human decision, not geometry. Consider Bitcoin's price history as a living example. Before every major breakout or crash, patterns appeared: ascending triangles, double tops, bearish divergences. Traders often argue about which pattern caused the move, but the truth is simpler. The pattern didn't cause anything. It merely revealed that something beneath the surface was changing. For example, when price makes higher highs, but momentum indicators like RSI make lower highs, that divergence reveals exhaustion, not fate. It's a clue that enthusiasm is fading even as price pushes higher. It's not a prediction that price must fall. It's a revelation that strength is weakening. Patterns reveal emotion disguised as structure. A breakout pattern isn't the market promising higher prices. It's buyers showing confidence and taking control. A breakdown isn't destiny. It's sellers revealing conviction while buyers hesitate. The pattern itself is neutral. What it shows is imbalance. This distinction separates analysts from gamblers. The analyst studies what the chart is telling them about the current state of emotion. Fear, greed, hesitation. While the gambler sees only profit or loss. The chart doesn't speak in certainties. It whispers in probabilities. Those who mistake those whispers for promises end up chasing ghosts. When you recognize that patterns reveal instead of predict, your mindset changes. You stop asking, what will happen? And start asking, happening right now that others don't yet see. This is the key to understanding technical analysis as a living language of behavior. The goal isn't to be right about the future. It's to read the present so clearly that you respond with precision when the next move comes. A symmetrical triangle, for instance, shows balance between buyers and sellers, a moment of indecision. It doesn't tell you who will win, but it reveals that a battle is brewing. Once the breakout occurs, the pattern helps you confirm the shift in control, not predict it beforehand. This difference is critical in times of high volatility like Bitcoin's market cycles. When traders misinterpret patterns as predictions, they enter too early, over leverage, and get trapped in false breakouts. They treat a technical setup as certainty instead of context. The professional, however, waits for confirmation because they understand the pattern's purpose: to reveal conditions, not to forecast results. The candle that breaks out, the volume spike that confirms conviction. Those are revelations that transform probability into decision. The pattern sets the stage. The market delivers the verdict. Every chart, if read correctly, is a story of energy being built and released. A consolidation pattern reveals equilibrium. A breakout reveals new control. A reversal reveals exhaustion. These are revelations about structure and sentiment, not prophecies. The analyst's role is to listen deeply, not predict loudly. Markets punish arrogance and reward awareness. Technical analysis is not an oracle. It is an X-ray machine showing what lies beneath price movement, what emotions are accumulating, and where stress is reaching its limit. In the context of Bitcoin, this becomes even more profound. The crypto market is dominated by emotion-driven participants, enthusiasts, skeptics, and speculators. Patterns in such a market are vibrant indicators of shifting belief. When volume dries up while price drifts higher, it reveals complacency. When wide candles appear after weeks of calm, it reveals panic or excitement breaking through restraint. Each of these signals is part of a psychological fingerprint the market leaves behind. The chart becomes a journal of emotion, and the analyst becomes its interpreter. The danger of treating patterns as predictions is that it replaces observation with ego. The moment you believe you know what will happen, you stop listening to what the market is actually saying. True understanding lies in humility, the acceptance that the chart reveals the truth of now, not the certainty of tomorrow. The market evolves continuously, rewriting its patterns as new information. Emotions and liquidity enter. Every revelation is temporary. Every structure is fluid. What was once support can become resistance. What looked like a reversal can extend into a trend. This impermanence is what makes trading an art as much as a science. Patterns don't predict, they reveal. They show us how emotion takes form, how structure emerges from chaos, and how the crowd expresses belief and fear in visible ways. To master technical analysis is not to master prediction, but to master perception. To see what the market reveals before others notice it. In that clarity lies the real edge. Every peak whispers of exhaustion. The moment the market looks invincible is often the moment it begins to break. In Bitcoin's story, we've seen this again and again. Massive rallies that defy gravity, only to collapse in spectacular fashion. But the collapse never truly begins at the top. It starts quietly, long before the headlines catch on. Technical analysis gives us the language to read those whispers, the subtle signals that emotion tries to hide. When the crowd celebrates, the chart starts to show cracks. Cracks that speak of fading momentum, of emotional overextension, of exhaustion masked as strength. A peak in the market is not just a high price point. It is the culmination of human belief stretched to its limits. Every trader, every investor, every influencer shouting, "We're going higher," is a reflection of collective euphoria. Yet, beneath that euphoria, energy begins to thin. You see it in volume. Buyers still push prices upward, but fewer of them are willing to join in. The candles remain green, but they shrink in conviction. The RSI starts to diverge, showing that momentum is not following price. The MACD begins to flatten. These are not coincidences. They are the signs of emotional fatigue. The market is still rising, but its heartbeat is slowing. What traders often forget is that price doesn't fall because of bad news. It falls because there are no new buyers left to sustain the story. Every rally feeds on belief, and when belief has consumed everyone willing to participate, the only direction left is down. Exhaustion is not an event, it's a process. It starts when the smart money begins to distribute while the public is still celebrating. It's when strong hands quietly sell into strength, creating distribution patterns at the top of the chart. The public doesn't see it. They're focused on the headlines, on promises of new highs, on the illusion that parabolic movement is normal. But the chart is already whispering a warning. Before every crash, there is a moment of hesitation that most traders ignore. The price stops accelerating. Pullbacks become deeper. Volume dries up during rallies. The chart shifts from enthusiasm to uncertainty, but because the numbers still look good, the crowd stays blind to it. It's like watching a candle burn brightest before it goes out. The same energy that pushed the market to extremes now burns itself out. The smart analyst doesn't look for the exact top. They look for the signs that the engine is losing fuel. They understand that every vertical climb ends not because the market turns evil, but because emotion runs out of breath. When Bitcoin hit its historical peaks, the signs of exhaustion were always visible for those who cared to look. There were RSI divergences showing loss of momentum, Bollinger Bands expanding excessively, and volume surges that marked the final wave of euphoria. Each indicator told the same story. The crowd was overcommitted. Buyers were no longer strategic. They were emotional. Every tweet, every forum, every headline screamed certainty. And that certainty was the signal. In markets, certainty is the loudest form of exhaustion. It tells you that the emotional pendulum has swung too far in one direction and is ready to snap back. In technical analysis, peaks are not random. They're built layer by layer through overconfidence. Rising wedges, narrowing price channels, and extended moving averages are structural footprints of that overconfidence. They reveal a market that's running faster than its own balance. Think of it like an athlete sprinting beyond endurance. The movement is impressive but unsustainable. The signs of exhaustion are not failures. They're natural indicators that the system is reaching its limit. The problem is most people ignore those signs because emotion clouds perception. When profits rise, discipline fades. And when discipline fades, exhaustion accelerates. Understanding this rhythm changes how you trade and how you think. The best analysts are not surprised by market crashes. They are prepared for them. They recognize that no rally lasts forever, that no euphoria sustains itself indefinitely. They listen to what the chart says, not what the crowd feels. When the market makes new highs, but indicators lag, when volume fails to confirm price, when volatility expands beyond structure, those are the quiet whispers of exhaustion. The untrained eye sees opportunity. The trained one sees warning. What makes exhaustion so powerful is that it hides behind success. It doesn't announce itself with fear. It wears the mask of triumph. Traders feel invincible at peaks, not vulnerable. But the market always humbles those who mistake momentum for immortality. The signs of exhaustion are not punishments. They are opportunities for awareness. They invite the disciplined trader to step back, protect gains, and wait for the next structure to form. In the grand rhythm of Bitcoin cycles, every peak has carried this same pattern. Price surges beyond logic, enthusiasm replaces analysis, and then the signs appear: lower highs on indicators, slowing volume, overextended moving averages, and compressed volatility. These are not technical coincidences. They are emotional realities expressed in data. The market doesn't crash because of charts. It crashes because emotion reaches a saturation point. To understand that every peak whispers of exhaustion is to understand that the market speaks before it acts. It doesn't shout, it murmurs. It tells the attentive analyst that the energy driving it upward is almost gone. It tells those who can listen that the applause is about to fade. Every peak, no matter how glorious, carries within it the seed of its own decline. Not because markets are cruel, but because emotion, when stretched to extremes, must always return to balance. And that balance, that inevitable return to equilibrium, is the heartbeat of every market cycle. Crashes are cleansing. It's a phrase that feels almost paradoxical at first, especially to those who have lived through the pain of watching their portfolio dissolve in real time. Yet, beneath the fear, chaos, and panic, there's an undeniable truth. Every crash strips away illusion and forces the market to return to its core reality. In Bitcoin's history, each crash has been a reset button. Painful, yes, but necessary for long-term health. Technical analysis doesn't just show where markets fall. It shows how those falls cleans the emotional and structural excesses that built up during euphoric rallies. What feels like destruction is actually renewal in disguise. When the market soars relentlessly, greed begins to take control. Prices move beyond logic, beyond valuation, beyond reason. The chart reflects this as parabolic rises, vertical surges where momentum outpaces sustainability. During such times, no one questions the trend because the prophets silence doubt. Indicators stretch far beyond their means, RSI overbought levels stay elevated, and volatility expands without restraint. These are signs not of strength, but of imbalance. Too much energy trapped in one direction. The crash that follows is nature's way of restoring equilibrium. Just as a forest fire clears deadwood for new growth, a market crash burns away speculative excess and emotional complacency. The cleansing nature of a crash becomes clear when you study how structure rebuilds afterward. In the heat of the fall, support levels are broken, panic selling spikes, and indicators swing from overbought to oversold. The crowd interprets this as chaos, but a trained eye sees something deeper. Emotion is resetting. Those who bought in greed are forced to sell in fear, transferring their assets to more disciplined hands. Weak positions are purged, leverage is reduced, and volume eventually stabilizes. This process is brutal but vital. Without it, markets would remain inflated by false confidence and distorted by emotional extremes. A crash brings prices back to where genuine demand exists, not where speculation wishes it to be. Consider Bitcoin's past cycles. After every euphoric rally, there comes a crash that feels catastrophic. Yet, each of those collapses laid the groundwork for the next phase of growth. The 2017 crash, the 2021 corrections, the countless smaller downturns in between. They were all stages of cleansing. They force the market to pause, reflect, and rebuild on stronger foundations. During these phases, you see accumulation patterns form, marked by steady volume and flat price action. Those patterns are not signs of death, they're signs of rebirth. They show that the speculative noise has faded and real investors, those who study structure, not emotion, are stepping back and quietly. Technical analysis offers a fascinating lens to view this process. Indicators like RSI and ACV swing from extremes during a crash, signaling emotional capitulation. Volume spikes reveal panic selling, while wide candles show emotional volatility. Yet, as the selling pressure subsides, these indicators begin to stabilize, revealing the market's slow process of healing. The patterns that form in the aftermath: double bottoms, rounding bases, long consolidations are all reflections of emotional recovery. They represent the market rediscovering balance after a period of chaos. It's here in the quiet aftermath that smart traders start observing instead of reacting. They recognize that the market, once cleansed, becomes fertile ground for disciplined opportunity. What makes a crash so instructive is how it exposes human nature. When everything falls apart, illusions die first. Traders who believed in "it can only go up" are forced to confront risk. Analysts who ignored warning signals rediscover humility. The crash cleanses not just the chart, but the mindset. It teaches lessons that no textbook or seminar could ever match. It reveals who was trading on conviction and who was trading on emotion. It separates skill from luck, discipline from arrogance. Every seasoned trader has scars from a crash, but those scars are wisdom written in experience. In the emotional landscape of a crash, fear becomes overwhelming. News outlets amplify panic, social media echoes despair, and the majority retreat from the market entirely. But for those grounded in technical analysis, fear is data. Oversold conditions, high volume at key supports, and exhaustion gaps. All these signals reveal where selling is losing power. The crash, through its chaos, becomes transparent. It tells the analyst that emotion is reaching its limit, that the storm is nearing calm. This understanding transforms panic into perspective. You realize that the same emotional forces driving the market down will one day drive it back up. The cleansing is temporary, but the balance it restores is lasting. A crash also brings back discipline. When prices fall, traders are reminded of the principles they ignored during the rally: risk management, position sizing, and patience. The pain of loss renews respect for process. The market becomes quieter, more rational, and less crowded with noise. That silence is where clarity returns. It's where the next strong hands begin to build positions slowly, without headlines or hype. This phase doesn't feel exciting, but it's the healthiest stage of the cycle. It's where true value is discovered and where emotional excess gives way to analytical precision. So, while the word crash evokes fear, those who study the market deeply understand it as part of its natural rhythm. Every crash is a purification, a cleansing not just of prices, but of sentiment, ego, and illusion. The market sheds its extremes, exposing what is real and sustainable. In Bitcoin's world, where speculation often runs wild, this cleansing is essential. Without it, the structure would eventually collapse under the weight of its own euphoria. A crash, painful as it feels, is the market breathing again, resetting emotion, recalibrating structure, and reminding everyone that in every downfall lies the seed of the next ascent. Discipline over drama. It's one of the hardest principles to live by in trading, especially in a market like Bitcoin, where volatility feels intoxicating. The charts move like lightning. Social media feeds overflow with opinions. And every candle seems to scream urgency. But amid that noise, the only constant truth is that discipline separates the survivor from the spectator. Technical analysis isn't about predicting the unpredictable. It's about cultivating discipline strong that noise loses its power. Drama entices emotion. Discipline anchors reason. The best traders don't just read charts. They manage themselves. In a world where prices can rise or fall 10% in an hour, it's easy to confuse excitement for opportunity. Bitcoin's volatility seduces even experienced traders into impulsive actions. You might see a breakout and jump in too early, or watch a dip and panic sell, believing you're protecting your capital. In those moments, it's not the chart that fails. It's discipline that collapses. Emotional reactivity turns probability into gambling. The chart signals are neutral, but your interpretation isn't. When fear or greed dictates action, the market becomes a mirror reflecting your lack of control. The discipline to wait, to confirm, to act only when the structure aligns with your plan. That is what defines mastery. Discipline in trading is built through process, not emotion. Every decision must be guided by structure, entries, exits, and risk parameters defined before the trade begins. The disciplined analyst doesn't chase green candles or react to red ones. They understand that markets breathe, they expand and contract in cycles. Technical analysis offers the language of that rhythm, moving averages, volume trends, support and resistance. But discipline gives it meaning. Without discipline, even the most perfect analysis collapses under emotional weight. It's not enough to know the signals. You must trust them enough to follow through, even when emotion demands you do the opposite. Drama thrives on uncertainty, and the Bitcoin market is full of it. Every headline, every rumor, every sudden surge in social sentiment adds to the emotional storm. Traders who chase that noise find themselves trapped in a loop, constantly reacting, constantly regretting. Discipline breaks that cycle. It reminds you that you are not competing against the market. You're competing against your own impulses. The real skill lies in sitting still when everyone else is panicking or celebrating. In those quiet moments, clarity returns. The disciplined trader uses patience as their edge, waiting for confirmation, for structure, for balance. They understand that action without context is chaos. Technical analysis provides the roadmap, but discipline drives the journey. A chart may show a clear breakout pattern, but discipline tells you to wait for volume confirmation. Indicators might suggest a reversal, but discipline keeps you from guessing too soon. The difference between a professional and an amateur isn't knowledge, it's consistency. The professional knows that missing a trade is better than forcing one. They see no shame in waiting for the right setup because they know that preservation of capital is the foundation of longevity. Every undisciplined decision chips away at that foundation. Every emotional trade weakens your edge. Bitcoin's history offers countless lessons on the cost of drama and the power of discipline. During rallies, traders get swept away by euphoria, forgetting that parabolic moves are unsustainable. During crashes, they drown in fear at the worst, selling the worst possible time. Yet, the disciplined few Those who adhere to their structure endure both extremes. They understand that the market's drama is a test, not an invitation. While the crowd oscillates between greed and despair, the disciplined observer simply reads the data. They follow the structure, not the sentiment. They know that emotions may color perception, but charts record truth. Discipline also means knowing when not to act. The most dangerous moments in trading are not the losses. They are the times when the market lures you into false confidence. A few successful trades can create the illusion of control, leading to over-leverage and recklessness. But the disciplined trader knows that success is rented, not owned, and rent is due every day in the form of humility. They trade every trade as an independent event, unaffected by the last win or loss. They understand that discipline is not about perfection, but about consistency. It's about showing up with the same mindset, whether the market rewards or punishes you. The drama of the market will never disappear. There will always be panic, hype, rumors, and extremes. But discipline acts as armor. It shields you from the noise and helps you see what truly matters. Structure, do. Probability, and process. In technical analysis, this means adhering to your system even when it feels uncomfortable. It means setting stop losses and respecting them. It means taking profits when your plan says to do, not when emotion tells you to hold for more. Discipline is doing the boring thing repeatedly until the market rewards you for it. In Bitcoin trading, where volatility magnifies every mistake, discipline becomes the trader's compass. It keeps you from being swayed by every tweet, every headline, every surge of excitement. It reminds you that the goal is not to be right. It's to be consistent. Drama may offer excitement, but excitement fades. Discipline endures. The market rewards those who can stay calm when others lose control, who can analyze when others react, who can wait when others rush. Technical analysis shows you what's happening. Discipline determines what you'll do about it. And in the end, that difference, the quiet strength to act without drama, is what defines lasting success in any market cycle.